Hello there and welcome to Africa Business Weekly, your highlight of the biggest conversations that shape the continent's landscape this week. As the first half of the year winds to a close, Rwanda is positioning itself as a haven for business, as the Rwanda Development Bank is actively wooing Kenyan investors. Now from our West African desk, the president of Dangote Group, Aliko Dangote, says plans are underway to list Dangote fertiliser on the Nigerian exchange this year, as well as Dangote refinery in 2026. Well, let's now get into the business of the day with our first cross into South Africa. Karabo is on standby. Hello, Karabo.
Very good evening to you and to our viewers. So earlier this week, CNBC Africa caught up with the president of Botswana, Duma Boko, for his take on the necessity of this year's US-Africa Business Summit in addressing practical solutions and funding pathways for development projects. The summit wrapped in Rwanda, Angola on Wednesday.
It's been a very enriching and enlightening experience. This forum brings together government and the private sector. It is a partnership that is required to drive investment and economic growth. And the conversations have been practical. They have addressed what the challenges are, diagnosed really, and proffered suggestions and solutions to addressing these challenges practically. Not just projects that are suggested, but identified ways of funding these projects, these investments. So it's been a very useful forum.
One of the things we've been talking about, at least over the past couple of years, is Africa's voice being heard on the global stage and Africa being able to sort of have an autonomy and a voice, so to speak. What do you make of the way Africa has been able to relay itself to the rest of the world?
The first thing that Africa had to do, which is what it is currently in the process of doing, was to reorganize itself and rely on its own strength. And that strength can be mobilized if Africa unites. If Africa is able, at the level of trade and investment, to do that on the African continent. We now have the Africa Continental Free Trade Area Agreement, which seeks to do exactly this. It also is now being undergirded by a digital trade protocol. This calls for digital infrastructure across the length and breadth of Africa. It calls for connectivity amongst the African countries. It also calls for a removal of barriers and barricades that impede trade between African countries. We now are seeing the development of trade corridors that will interconnect many of the regions for trade and for investment. And so Africa is beginning, if one may put it crudely, to take itself seriously, then to look to the rest of the world and demand to be taken seriously. In fact, I don't think it would even have to make that demand. It will just follow naturally. Why? Because Africa is home to 1.5 billion people. It has a dynamism that is undeniable. There's everything unique about Africa. Africa is the place to be. And so the world will pay attention. The world is under obligation to pay attention to a resurgent and united Africa. And that's what Africa is doing now. So with the Africa Continental Free Trade Area Agreement, with the digitalization of many of the African countries, and I see Angola, I was in Mozambique recently, Botswana is doing pretty much the same thing. I was with the president of Gabon. You can see that the affinities, the natural, social, and historical ties that exist amongst Africans are beginning now to count in investment and to count in production. And so this productive capacity of a very young and dynamic population on the African continent, this youthful vitality and verve will drive the resurgence of Africa and it will cause Africa to be taken very seriously. And there's a new leadership that has emerged, and it is set to grow and get entrenched on the African continent. A leadership that is about developing Africa, a leadership that is about creating opportunities for Africans in Africa.
More than a year after South Africa's landmark 2024 election, which saw the formation of a government of national unity, the country is navigating a new era of coalition politics amid a shifting global economic landscape. At home, we're seeing signs of resilience, from improving power stability to stronger institutions, while abroad, headwinds from global interest rates, trade tensions and shifting alliances remain. CNBC Africa's Nomonde Kulu spoke to Kumesh Mudlia, who is the CEO of Investec South Africa, on what all this means for South Africa's economy, business confidence and investor appetite.
I think as we look at the SA macros, and I suppose we're living in a world where almost hour by hour, day by day, things change really quickly, and that has an immediate influence and impact on the macros. If we look at SA today, I think we look at our core fundamentals. In many respects, if we look at inflation, inflation's being well targeted, well under control. 2 weeks ago, or just over 2 to 3 weeks ago, we got a 25 basis points cut in interest rates. So the interest rate environment is feeling more benign. And we look at the outlook and we think there's a further 25 basis points cut within the context of this year. So what you're seeing from a monetary policy perspective is positive. I think inflation outlook is also becoming more muted. One of the concerns was obviously looking at what was happening in the Middle East, the war in the Middle East, the potential impact on the oil price. Over the last day or two, again, you see that again seems to be moderating. Oil prices come off again, and the potential risk to inflation as a result of that, again, is moderated. So all of those aspects appear to be fairly well controlled. I think what we're wanting to see, if I take a step back and I look at as we enter 2025, we had GDP growth forecasted at about 2%. Yeah. As I sit here right now and chatting to our economists last night, we've revised that down to just under 1%. So that's disappointing. We entered the year with a lot more optimism, and then I think some of it was out of our control when we look at what's happened out of the US, the debate around tariffs, the potential impact of how all of those tariffs play out. And over the next couple of weeks, we'll see more of how that gets defined. Because the postponement of the tariffs globally by the US, I think, was postponed to around the 8th of July. So we'll hopefully get more clarity as to what that looks like. That does impact all of our positioning globally. I think from an SA macro perspective, what's very key for us is now to see that we've had the budget passed. What's in the SA budget for the next 3 years is R1 trillion of infrastructure spend. What's going to be really important for us is now to ensure that actually becomes a very real number. And I think as we look at that, some of what's probably been disappointing has been the pace of progress in terms of structural reforms from an SA perspective. I think we've really slowed down in some of the key areas. I look at energy. The energy crisis galvanized SA into action, and we saw significant progress being made there. One sense right now is that things have slowed a bit, and I do understand that all of these things take a lot of time to process. What we do see from clients is clients are more risk on, more keen to engage. A more benign interest rate environment steers people in the right direction. I also think growing geopolitical uncertainty in some areas actually favors South Africa. So often where people would, and against a context of a strengthening rand in the last period of time. And that's something that people didn't initially factor in. So in all of that, people still see the opportunity to invest in SA. We're seeing our own private clients and corporate clients activity levels picking up. We think there's capacity for that to pick up a lot quicker, and that you could influence the macros more positively. But I think you need very, very clear guidelines from government around speed of execution and timelines.
And those were some of the stories making headlines in Southern Africa for this week. For the full interviews, you can, of course, see our website, cnbcafrica.com.
Thanks a lot for the updates there, Karaba. It's now time to cross over to East Africa with Tabitha.
Hello, David. Can you believe we are already halfway through the year? It's a perfect time to reflect on some of the powerful conversations you've had across the continent this week. We begin with MSMEs, an engine of Africa's economic growth. Ahead of World MSMEs Day, I spoke to Elizabeth Wasuna Ocho, the Business Banking Director at Absa Bank Kenya. With the SCFTA paving the way for cross-border trade, we discussed what more can be done to finance, empower, and connect MSMEs to scale across the continent.
MSME Day is a really important day for us to celebrate because it really speaks to the importance of the global movement that recognizes the critical role that MSMEs play in our economy. Back home in Kenya, we see SMEs growing day by day, and the impact that they have in terms of employment, empowerment of households. It is really important that we really support them each and every time. When we look at, from an African perspective, 20 to 30% of MSMEs in Africa have access to credit, but they still face challenges. So it's an important day to just reflect on how far we've come and perhaps how far we've got to go. So I think for me, it's long overdue for us to have been celebrating this day, but it's good that we are focused on ensuring that we put them, MSMEs before us and really strive to push them forward, because I do believe, and we do believe as a bank, that they have great potential of changing the landscape of Africa and indeed Kenya.
And when we say shaping the landscape of Africa, more so Kenya, let us look at some of the roles we have seen the MSMEs play in Africa's growth and recovery, because what I'm looking at is what is at stake here in terms of growth, scale, and some of the macroeconomic implications. You can expound a little bit more on this.
Yeah. When you look at MSMEs, and they do form the majority in any country that you speak to across Africa, and you look at the kind of job opportunities that they do provide, the opportunities to empower households, because in the SME space, we have a lot of women as well. And the opportunities for us to grow in terms of being able to pay taxes. This is an area, this is a job group, or this is a sector that, if harnessed well, if provided growth opportunities, they can really change the landscape. Then you look at such a bigger initiatives like the Africa Continental Free Area Conversation. MSMEs form a critical portion of it. And even if you look at it from a traditional perspective, where there's barter trade, where there's opportunities to do cross trade at the borders, this is MSMEs doing a lot of the work. So when you say, do they have an opportunity for growth? Absolutely, but they do need support. They do need financial support. They do need non-financial support as well. When I speak about non-financial support, how do we edify them? How do we make sure that they're prepared for the tough environment that we find ourselves? If corporates are struggling in an area, countries across Africa based on the macros, you can imagine the impact it has on MSMEs. So they do need empowerment on that front to ensure that they can really step forward and grow and continue to provide jobs, continue to provide, support from an economic front, and for governments really to be able to pay more taxes.
And yes, the African Continental Free Trade Agreement is very critical, looking that most countries are moving into that. And we do have Ethiopia already, who are going to start their trading come July 1st. But let us look at some of the innovation models that we are seeing that businesses can use to help them scale to the ACFTA level. And also, how best can we address policies? Yes, you have mentioned the role of governments here, some of the key stakeholders when it comes to thriving under ACFTA, but what more is left to be seen, especially for MSMEs?
Wow, there's a lot expected. Traditionally in an African continent, we've operated within different legal frameworks. First and foremost, from a government perspective, we must be able to encourage governments to have better opportunities, better laws, better governance, corridors for us to be able to operate in. When we look at from a financial perspective, currency, from one currency to another, we must be able to enable that. So are we going to use dollar? Are we able to use, shillings? What are we able to use across? And if whatever currency we decide to use, what platform are we going to be able to use? So it can't be the usual, cash conversation. We need to embrace more of the digital conversation.
From MSMEs to regional integration, while Kenya continues to navigate a turbulent political landscape, neighboring Rwanda is positioning itself as a haven for business. The Rwanda Development Board is actively wooing Kenyan investors, showcasing opportunities in sectors ranging from ICT and mining to agriculture and real estate. CNBC Africa's Abia Gena caught up with Dennis Ketera for insights on what Rwanda is doing to attract and retain regional capital.
The key issues, first, it just provides a platform for different businesses to discuss areas of interest where they can expand, the market opportunities available. it's also good for RDB to showcase what it does in terms of trade facilitation, investor facilitation, and be sure how we can maybe smoothen further the process. Cross-border trade with Kenya is very important to us. They're one of our most important trade partners, and we're looking to specifically showcase the opportunities that we have and look to have our Kenyan counterparts take advantage of those, and also our private sector to be able to discuss with the Kenyan private sector.
All right. And one of the biggest challenges businesses are facing in East Africa is trade facilitation and having an environment that is conducive for businesses to thrive. As RDB, what are some of the strategies you are rolling out to support businesses to set up and to be able to come and invest in your country?
Thanks. So a couple of things that we're doing. One, we've set up a true one-stop center at RDB. So it's one place at RDB where you can come and get over 400 licenses. So no more going to different organizations trying to get set up. You can do that all in one place, and RDB is there to handhold and also take you through that process. We are also taking away the logistical hurdles that are inherent. Rwanda is a landlocked country, so we're looking for ways where those logistical hurdles can be brought down further, where it's faster to go back and forth, but also cross-border trade. So the one-stop centers at the border points, and also opening up the markets that Rwanda can help you tap into. And here we're talking about Burundi, we're talking about Congo, some of the bigger markets where it's not just Rwanda that you're targeting, sure, but the regional neighbors.
And looking at the importance of trade, right now we have the Africa Continental Free Trade Area. It's something that has been very dear to President Kagame. And looking at Rwanda as a country, we've seen an effort towards setting up special economic zones. And talk to me about this, as well as what would be your message to investors in terms of sectors that Rwanda is keen to attract investment?
So I think that's all part of business facilitation that we try to do, right? Make it easier for investors to come and set up. So the special economic zones just provide areas where an investor can, it's a plug and play for you. It's an area set up, you can get your licenses there, you have your revenue authority there. So it's easier for you to come, get licenses that you need to set up, and then start transacting. We prefer you doing business rather than looking for licenses and talking to governments, yeah, right? So that's very important to us.
That wraps up our regional roundup for the week. Back to you in the West.
Many thanks, Tabitha. It's now time to bring our focus back to West Africa, where the president of Dangote Group, Aliko Dangote, says plans are underway to list Dangote fertiliser on the Nigerian exchange this year and also list Dangote refinery come 2026. Speaking at the Afreximbank annual meetings in Abuja, he forecast in the next 40 months, Africa will not need to import fertilizers, while noting based on the group's aggressive trajectory, plans also underway to put Dangote as the largest producer of urea, even bigger than Qatar.
Somebody was asking me a question. I think some people came to visit our own fertilizer, and I was telling them that, you know, I've said it before in one forum, that in the next 40 months, Africa will not import fertilizer from anywhere. We have a very aggressive trajectory right now. We want to put Dangote fertilizer to be the largest producer of fertilizer, of urea, bigger and higher than Qatar. And watch me, 40 months. Give me 40 months. When you look at the vision and also the mission of Afreximbank, is to connect all these dots. The trade financing is there. They are not the only ones. There is also Africa Finance Corporation. There are other banks. Once they build, if they are going to raise capital, believe me honestly, today, even if I'm not going to make money, I would rather invest in banks that have the same vision like Afreximbank, because that's the only way that we can develop our continent. You know, I mean, forget about most of these other banks. Their interest is not for Africa to grow. We must make sure we take it as our own focus, as our vision that, look, how do we make Africa great? Africa can only be made great by Africans. When we start insisting on our minerals to be processed in our continent, you see the rush. Everybody rushed to come down here. Don't take our mineral sources, process them here, create value, generate jobs and growth. And it can happen. You know, our oil industry here, especially the downstream, has been enmeshed with so much of corruption, lack of investment in terms of distribution, and also people are still grappling with other issues. So we came up with something where we are saying that, yes, you pay for your product, aviation fuel, gasoline, which is, PMS, and diesel. All the telecom companies, the industries, and we are saying, give us a location all over Nigeria, even up to 3,000 kilometers, will deliver to you zero charge. And somebody said, but do you know what it is? I say, yes, we have an idea. I think we're actually pumping back into the economy almost about 1.2 trillion naira. And that's what we are doing. They say it's competition. So we're asking other people to please also come and compete with us. We are going to list the fertilizer this year. And next year, I think we'll list the refinery. It is very important for us to list the refinery so that people will not be calling us monopoly. They will now say, yes, we own part of it. So let everybody have shares.
Next up, S&P Global Ratings believes the direct impact of shifting U.S. trade policy on economic growth in emerging markets has also so far been modest amid lower than feared effective tariff levels. In a chat with Elijah Oliveros-Rosen, chief economist of emerging markets at S&P Global Ratings, on the firm's third quarter economic outlook for emerging markets, notes there are significant downside risks to the growth outlook, such as the potential for higher oil prices amid escalation of the conflict in Iran, a weaker than expected U.S. economy, more upside pressure on long-term U.S. Treasury yields, and challenging fiscal dynamics across several emerging markets. Have a look.
We have two major global risks that we identify as we try to shape up our macroeconomic projections for emerging markets. Both have receded somewhat in recent days and weeks, but they're still material and could influence how we think about macro projections looking forward. Those risks are geopolitics and trade policy uncertainty. Now, on geopolitics, we have seen a truce, which we consider a fragile truce, and the risk of escalation is still very much alive. And if we were to see an escalation, we understand what the channels of transmissions of that escalation are to other emerging markets. There's two channels of transmission, one being energy prices. We understand which emerging markets are the ones that are most exposed to this channel, especially those that are large net energy importers. Most of those are in EM Asia. So you have countries like Thailand, India, the Philippines, all import over 4% of GDP in energy. And then the second channel is financial conditions. What does a potential re-escalation of the conflict do to financial conditions? The emerging markets that are more exposed to financial conditions are those that are usually lower rated credits, so sub-investment grade, and those are spread out around the globe. And then on the second risk, trade policy uncertainty, sure, we're approaching a period where trade risks seem to have receded after that de-escalation between the US and China. But we also have several things we're looking towards too. We have the 90-day pause that is coming up next month to these higher reciprocal tariffs. And we think, we're going to still continue to live in a world of uncertainty towards trade policy, and that's going to impact how we think about growth in emerging markets.
So we have the risks on the one hand. Now, let's talk about the macro baseline here.
We have increased most of our economic projections for emerging markets for the main reason that the direct impact of trade, tariffs on trade, has been lower than we anticipated. Sure, we have seen quite a bit of volatility. U.S. imports in March increased quite significantly, front-running, a lot of the expected tariffs in April, and then they were unwound the next month. So we have seen a lot of volatility, but if you average everything out, trade hasn't deteriorated that materially. So the impact on emerging markets from tariffs has been small. Now, the question is, will this continue? Our view is that we will see a deterioration in trade, especially in the second half of the year. The main reason being that producers in the US have not yet passed on higher prices to consumers, reflecting the impact of tariffs. But we think that's going to change in the second half of the year as they restock inventories with higher cost imported goods. So the second half of the year will be a bit weaker on the trade front than the first half, and we will see that being reflected in export numbers out of EM economies.
And let's now narrow down into three key markets we have captured in your report here. We have Nigeria, we have Egypt and South Africa. We have a downward revision about 20 basis points for South Africa. We're still waiting for Nigeria's GDP report to come out. So I know that's also a challenge in terms of direction here. But when we're looking at holistically the movement within this market, what should we expect within this quarter, the next quarter?
Right. So, all of those countries are also subject to what's happening globally. So we would expect some of the similar trends on weaker trade in the second half of the year, especially. Now, in South Africa's case, we lowered our growth rate because Q1 was a bit weaker than expected. Q1 expanded only 0.1% quarter on quarter. And also, there were downward revisions to Q4, which just lowers our average growth for this year as well.
And that's it on this week's show. Many thanks, Karabo and Tabitha, for the regional update. And thank you for your company on Africa Business Weekly. I'm David Alabi. Enjoy the rest of your day. Bye for now.